Valens Research, Uniform Financial Analytics.
FICO is the company whose framework of credit scoring has been powering for the last couple of decades how we think about credit risk for individuals. When you think about Equifax or Experian or TransUnion, all of them start with the framework that Fair Isaac FICO gives them, the data that Fair Isaac gives them on credit ratings. So as credit has become more and more important for individuals, of course, you would expect that FICO has become a higher and higher return business. But let's see how this looks on a uniform accounting versus as reported basis. What we can see here is whenever we look at a company in the Valens Research app, we always start right here. What is this? This is their PVP chart, specifically our performance and valuation prime chart. Again, we're really literal people here at Valens. Why performance? Because we look at the performance of a company in terms of its return on assets and its asset growth. And we look at the valuations of the company, right? Its valuations relative to its asset base. Think about it as a cleaned up price to book, and valuations relative to earnings, like a cleaned up PE. We always show you when you first come in here, this framework on both what you're seeing on an as reported basis and a uniform accounting basis. And what you can see here, these orange bars are the orange distorted as reported return on assets for Fair Isaacs. When you look at Fair Isaacs on an as reported basis, you would think that this company is a 14% ROA business. It's actually improved decently from where it was in 2010, where it was a 6% ROA firm. But it's still, considering how it is at the heart of consumer credit, which is what's been fueling this economy for decades, surprising that returns are that low until you realize that returns aren't actually that low. Return on assets for Fair Isaacs is actually almost 4 times, well, I should say 3 times, what as reported metrics show it to be, right? As reported ROA for this company is 14%. In reality, this company is a 44% ROA in 2020. A really impressive return on assets in terms of how profitable this business is. And it hasn't just increased from 6% to 14, it's increased from 15 to 45. The average company in the US, for context, has about a 10% return on assets. That just shows how profitable this business is and how powerful it is in terms of where it fits in. And we'd only see that looking at the uniform accounting data. The next framework, the next chart, I should say, is asset growth, right? And here, very similarly, we show you the as reported asset growth for this company. And then we show you the uniform accounting, true blue uniform asset growth for this company. And you can see one of the interesting things for Fair Isaacs is FICO has actually been growing even more than as reported metrics reflect. This company isn't just more profitable than as reported metrics reflect. It is compounding this highly profitable business faster than you would realize if you were looking at as reported metrics. This is fundamentally a way better business than as reported metrics make you realize, because it can both grow and have high returns. This next chart is valued asset prime. Valued asset prime is just our cleaned up version of a price to book metric. And now the wild thing with Fair Isaacs is if you look at it on an as reported basis, you would see a price to book of 105 times. You'd say, what am I looking at? This company must be insanely expensive. Well, in reality, it's a lot cheaper. It's not cheap on an as reported on a price to book basis. It's still trading at 15 times. That's a stiff multiple relative to assets. But in the context of the return on assets it generates, that's not unreasonable, as opposed to what do you do with 105 times price to book? That's not even meaningful. And similarly with PE, you can see one of the really interesting things is that on an as reported basis, it looked like PE got really expensive in 2018, 2019, 2020 when it was trading over 30 times. In reality, really until this year, this company wasn't trading at much of a premium to the market when we look at an as reported basis. So this can help us understand not just how good of a company is it, but what is the market really paying for this company? And the last chart is TSRR. TSRR stands for total shareholder return. Total shareholder return, for those of you who don't know, is the return that you can get from a stock in terms of both capital appreciation, the stock rising, and any dividend income you get from the stock. And then the second R here is relative. Relative to what? Relative to the relevant index for the company. So this company is a US-based company. It's versus the S&P 500. So when you look at this chart, when it's flat, like it was from 2006 to 2007, that means the stock performed in line with the market. When it's down, like it was from 2008 to 2009, that means the stock underperformed the market. And when it's up, like it was these periods, that means the stock outperformed the market. And what's really interesting is oftentimes we don't see any relationship between the orange distorted as reported return on assets and growth for a company. But what we do see is a phenomenal relationship between the TSR for a company and the return on assets and asset growth for a business. And you can see it here, right? As a company had ROAs expanding, not basically flat, TSR was rising pretty significantly. And then as the company started being able to plow money back in the business while also having high return, high ROA maintained, TSR continued to take off. Why? Because the market is paying attention to the uniform accounting metrics, not the as reported metrics. Now, all of that is great. It helps us understand how good a business is, how profitable it is, how much it can grow, and what valuations are, but that doesn't tell us if it's a buy or not. For that, we need to look at these last 5 bars here, which are really, if you will, the secret weapon of Valens Research and the Valens Research app, and that is understanding what analyst and market expectations are. These 2 light blue bars here are what the uniform accounting return on assets and asset growth for this business is forecasted to be by Wall Street analysts if we push their estimates through our uniform accounting framework. And then those last 3 bars, the white bars, are if we take what the market is pricing the company to do. So at a $13 billion market cap for this company right here and a $450 stock price, what does the market expect Fair Isaac's FICO to do? And so what we can see here is analysts forecast that 2021 is going to be a banner year, with ROA rising to 52% from 44% last year, which was a prior high. What the market, what investors are expecting this company to do is for ROA to keep on rising up to 58% over the next 5 years, with this company still healthily reinvesting in the business like it has historically. Now, the company could do this, but if you look, the reality is over the last couple of years, other than this dip in 2018, really ROA has mostly been around, call it 40 to 45%. So if we think this company could only actually be a 45% return on assets business, what we can do is we can use the embedded expectation tool here to understand what would the company be worth. And what we can see is if Fair Isaac doesn't keep on seeing returns boost because credit becomes more important and they are the vendor of choice for everybody, right? If let's say people start to question whether or not FICO's credit score is actually that good, because the fact that FICO's credit score doesn't capture some things for people who are the underbanked and everything else, and we think that return on assets might just plateau, right? Then this company has 23% downside. It's actually only worth $350, not $450. And look at how fast we can do that analysis. Because the fact that we can understand where ROAs have really been for the last couple of years, they've really been flat the last 5 years. They haven't risen from 9% to 14%, like as reported metrics reflect. That can change our context of the conversation and also help us understand why this company is already really profitable. Can it keep on improving its profitability? We're totally changing the conversation looking at as reported metrics versus uniform metrics. And when we use those uniform accounting metrics in the Valens Research framework, we can more quickly do the scenario analysis that powers how we think about the firm.
Valens Research, the world's leading source for uniform financial analytics.